Hey guys, what we're going to do in this video is look at the relationship between the emissions trading scheme and external stability. So to recap what an emissions trading scheme is, it is a cap and trade system whereby the government allocates trading permits or polluting permits to businesses. So these businesses can only pollute so much carbon dioxide or emit so much carbon dioxide into the atmosphere. If they want to emit more, then they would have to purchase more permits. And so what this creates is it creates a cost to pollute. And it therefore mitigates the negative externality of pollution. To recap again what external stability is, it is characterized by three things. A low CAT to GDP ratio, perhaps say around 3 to 4%, a sustainable net foreign debt, and also a stable dollar. And when all three things are achieved, we call this when Australia is living within its means and able to pay off its financial obligations. And all these three characteristics sum up to, perhaps you could call it, create a situation where we are internationally competitive. So instead of looking at the relationship as part of these three pillars in this video, we're going to look at the relationship between an emissions trading scheme and our international competitiveness. I'm just going to note here, international competitiveness. So this video will be broken up into three parts. The first part we're going to look at how the direct relationship between the emissions trading scheme and international competitiveness. The second part of this video will look at the possible problems caused by the emissions trading scheme, so what we call a carbon leakage. And thirdly, we're going to look at how the government can in fact mitigate these problems arising from an emissions trading scheme in Australia. So firstly, we're going to look at this relationship between emissions trading scheme and our international competitiveness. So the relationship here is that because these permits create an extra cost of producing, so a increase in the cost of production, we will see that firms would tend to increase their prices, especially firms which are intensive on using carbon as their main way of production to maintain their profit margins. So we're going to assume that if legislation goes through, these permits are going to be $25 per ton. And so what happens is let's assume that it costs, say, 1/5 of a ton or 200 kilos to produce a unit of good, say for example. And let's say this firm is initially it costs $15 per bundle. And since it costs $15 per bundle to produce, they're going to mark this cost up to, say, perhaps $20. In New Zealand, we have a perfectly substitutable good, and in New Zealand, their cost of production is, say, $17. $17 per bundle in New Zealand. And so to keep this $5 profit margin, so they have plus $5, they're going to increase their price to $22 when they sell. So here in both cases they make $5 worth of profit. However, because these are identical goods, people are going to tend, or international importers will tend to buy from the Australian producer because they are only selling it for $20. So now let's say this bundle costs 1/5 of a bundle, 1/5 of a ton to produce a bundle of this good. So after the carbon tax, I'm just going to note in white here, this $15 would actually increase to $20 per bundle because of this 1/5 of a ton, and therefore it costs $5 to for the business to pay the government. And so the cost of production actually increases from $20 here, increases from $15, I should say, to $20 per bundle. And so as a result, we will see that to maintain the profit margin of plus $5, the Oz producer would have to increase their price to $25. So we can see now that international buyers would tend to now lean towards purchasing the New Zealand good. And assuming there are no quality differences, we'll see that the New Zealand good will be favoured because it is cheaper by $3. So if the Australian producer produced at $20 like they were before, then they wouldn't be making any profit. So this would erode our international competitiveness. So this, as a result, erodes international competitiveness. So that's the first problem arising from this trading scheme, is because when there is a cost to produce, or there's an extra cost to produce, this would result in a hike or an increase in prices, and as a result would create a situation where we are less internationally competitive. So how do these businesses counteract this? How do they solve this problem? I'll just rub this as an example out. How they solve this problem is by moving offshore. And this moving offshore problem, where they're trying to find a country which doesn't actually put a price on pollution, is known as carbon leakage. So carbon leakage is the problem where firms relocate offshore to avoid the ETS. And firstly, the problem associated with this is not only because firms are moving overseas and therefore would decrease the rate of job growth in Australia, but it also creates a situation where these ETS, or where these environmental policies, become ineffective because they're polluting in a different country, and they're still depleting our natural resources. So not only this is bad for our economy by us losing more jobs, it is also bad for the environment, given they're still going to produce more. So how does the government counteract or try to mitigate this problem of carbon leakage? Well, evidently they are going to gain more revenue. So the solution we're going to note here, or possible solution. So by gaining more revenue from these permits, they're able to subsidize firms, or firms that choose greener alternatives. So for example, with their revenue gain from selling these carbon permits, the government can in fact subsidize firms who are moving towards green energy. So obviously at the moment, solar, wind or hydro-powered electricity is a lot more expensive than coal-generated electricity. And so to compensate these firms, these governments would subsidize or give them payments so that they encourage firms to actually move towards a greener alternative, so that they help sustain our ecological sustainability for the future, and help also sustain economic growth into the future. So when businesses adopt new technologies, new equipment designed to avoid using these carbon permits, then the government would in fact subsidize these businesses, and that would create an incentive for these businesses to move away from carbon pollution, create a positive image for their business that they are concerned about the environment, as well as maintain a decent enough profit level so they can survive in the short term before they adjust in the long term. So we can see that although these environmental policies, especially the emissions trading scheme, may impact negatively on external stability in the short run because of this loss in international competitiveness, we'll see in the long run that possibly the creation of new jobs, and the creation of low-cost alternatives, greener alternatives, will help sustain a rate of economic growth that will create a situation where we are externally and domestically stable in the future.